Most traders lose not because they lack intelligence, but because they trust the wrong part of their brain at the exact wrong moment. The market does not reward the smartest person in the room. It rewards the most disciplined. And discipline is not a personality trait you are born with. It is a system you build deliberately, one decision at a time. Here is the paradox nobody talks about. The harder you try to make money in trading, the faster you lose it. The more emotionally invested you are in a single trade, the less clearly you see the trade in front of you. The more desperate you are to recover a loss, the deeper into the hole you dig. This is not motivational talk. This is neuroscience. Your brain under financial stress operates almost identically to your brain under physical threat. Cortisol floods your system. Your prefrontal cortex, the part responsible for rational decision-making, goes partially offline, and you start making decisions from a survival center that was designed for a world without charts, without leverage, and without options contracts. So before we talk about the 5 principles, you need to accept one uncomfortable truth. Your biggest enemy in trading is not the market maker, not the hedge fund, not the algorithm running against your stop loss. Your biggest enemy is the version of you that shows up after 2 losing trades in a row. That version of you is dangerous. And the only way to neutralize that version is to build systems so airtight that even your worst self cannot break them. Principle 1, trade the setup, not the outcome. Every losing trader is outcome dependent. They measure the quality of a trade by whether it made money. This is a fatal error in reasoning. A trade can follow your rules perfectly and still lose. A trade can break every rule you have and still win. If you judge your decision-making by outcomes alone, you will eventually start chasing wins and avoiding good setups that look similar to recent losers. This is called outcome bias, and it quietly destroys more trading accounts than any technical mistake ever could. The professional shift happens when you start measuring process instead of profit. Did you wait for your entry criteria to be fully met? Did you size the position according to your risk model? Did you place your stop where the trade was logically invalidated, not where your pain tolerance ran out? Did you avoid the trade when the setup was only halfway there? If yes to all of those, you executed a good trade regardless of what the candle did next. Here is a practical framework. After every trade, score yourself on process from 1 to 10 before you even look at the profit or loss number. Write down what you were supposed to do. Write down what you actually did. The gap between those 2 columns is your real work. Over weeks and months, as that gap closes, your results will follow. Not immediately, but they will follow. Because edge in markets is statistical, not individual. You need sample sizes of 50, 100, 200 trades before your edge shows up reliably in your equity curve. Stop judging each tree. Start measuring the forest. Principle 2, build a pre-trade ritual that removes ambiguity. Ambiguity is where bad trades are born. When you sit down at your screen without a clear framework, your brain fills the gap with hope, with fear, with whatever emotion is loudest that day. Markets are infinite in their complexity. There is always a reason to buy and always a reason to sell. If you have not defined your parameters before the session begins, you will find whichever reason matches your emotional state and treat it like analysis. The pre-trade ritual is how you standardize your mental state before the market opens. It does not need to be elaborate, but it needs to be consistent. Start with a review of higher time frame context. Where is the market structurally? Are we trending or ranging? Is price near a major level of historical significance or floating in open space? This takes 5 minutes and it orients your entire session. Next, define the 2 or 3 scenarios you are watching for today, not 10. Not a watch list of 40 tickers. 2 or 3. What needs to happen on the chart for you to engage? What would invalidate your directional bias? At what price does the setup trigger, and at what price does it fail? Write these down. The act of writing anchors the plan and separates it from the improvisation that happens when you are deep in a session and price is moving fast. Then step away from the screen. Go for a short walk. Drink water. Eat something if you have not. Come back with lower cortisol and a calmer nervous system. Your brain makes better decisions at a resting heart rate than it does in the middle of a fast-moving morning session with 3 positions open and your account down 1%. The ritual is not superstition. It is neurological preparation. Elite athletes do not walk onto a field cold. Neither should you sit down at a trading terminal cold. Principle 3, understand that losses are the cost of business, not evidence of failure. This principle sounds simple, but almost no trader truly internalizes it. Most traders, even experienced ones, experience losses as a verdict on their intelligence, their skill, or their worth. This triggers a psychological defense response. They either deny the loss by not closing the position and letting it run against them, or they overcorrect by revenge trading and trying to win it back immediately. Both responses are catastrophic. Losses are a line item. Every business has operating costs. A retail store pays for inventory that does not sell. A restaurant throws out food that was never ordered. A lawyer loses cases. A doctor loses patients. No sustainable professional practice is built on the assumption of a 0% failure rate. And yet traders expect to win every trade. And when they do not, the entire psychological structure collapses. Here is a reframe that actually works. Calculate what your average loss is over your last 100 trades. Let us say it is $100. Now treat every loss as simply paying the market $100 for the information that this particular setup, in this particular environment, on this particular day, did not work. You are not losing money. You are buying data. And that data, tracked carefully over time, will show you your strengths and your weaknesses with mathematical precision. When you genuinely stop fearing the individual loss and start valuing the information it contains, your execution becomes effortless. You cut losses quickly because there is no ego attached to being wrong. You move to the next trade without carrying the emotional residue of the previous one. You start seeing your trading account not as a measure of your identity, but as a tool you are using to generate long-term statistical returns. This shift takes time, but you can accelerate it by tracking every loss in a journal with a consistent format. Date, instrument, setup criteria, entry, stop, what happened, and what the data tells you. Patterns emerge faster than you expect. Principle 4. Master position sizing before you master anything else. Most traders learn technical analysis first. They study candlestick patterns, moving averages, support and resistance, indicators, volume profile, order flow, and all of that has value. But none of it matters if your position sizing is broken. Because broken position sizing means that a single bad trade can wipe out the gains from 20 good ones. And when that happens, the psychological damage is so severe that most traders never fully recover their confidence. Position sizing is the foundation of consistency. It is how you ensure that no single trade, no single day, no single week has the power to meaningfully derail your account. Here is the core principle. Risk a fixed percentage of your total account on each trade. Most professionals use between 0.5% and 2%. That sounds conservative. It is meant to be conservative because conservative position sizing keeps you in the game long enough for your edge to express itself over a large sample size. Here is the mathematics of why this matters. If you risk 2% per trade and you have a losing streak of 10 trades in a row, which can happen to anyone with a legitimate edge, you have lost approximately 18% of your account from peak. That is painful but survivable. You can recover from 18%. If you risk 10% per trade and you hit that same 10 trade losing streak, you have lost 65% of your account. You cannot psychologically or financially recover from that quickly. Most people never do. The second layer of position sizing is what is called variance management. Not all setups are equal. A setup at a major daily level with volume confirmation and a clear catalyst is a higher probability event than a setup on a 15-minute chart with no broader context. Some traders use a tiered system, risking the full allowed percentage on A-grade setups and half on B-grade setups. This way, your highest conviction ideas get the most capital and your speculative ideas do less damage when they fail. Position sizing is not exciting. It does not get talked about in the same breath as chart patterns or trading psychology, but it is the single most important mechanical decision you make in every trade. Get it right and nothing else can break you permanently. Get it wrong and nothing else you do right will save you. Principle 5. Create a feedback loop that actually changes behavior. Most traders keep journals in the same way most people keep diaries. They write in them for 2 weeks, then stop. They review them when things are going badly. They skim them without extracting actionable patterns. And then they wonder why they keep making the same mistakes 6 months later. A feedback loop that changes behavior is not just a journal. It is a weekly review process with specific questions and specific metrics. It is a monthly audit of your data. It is a quarterly recalibration of your strategy based on what the market environment has been doing, not what it was doing when you first learned to trade. Start with weekly metrics that actually matter. Win rate alone is meaningless. Your profit factor, which is the ratio of gross profit to gross loss, tells you whether your edge exists. A profit factor above 1.5 means you are generating real return. Below 1 means your edge is negative. Your average win divided by your average loss tells you your risk-reward ratio in practice versus the one you think you are executing. These numbers often diverge significantly, and the divergence itself is the lesson. Then look at qualitative patterns. Which days of the week do you perform best and worst? Which Which session, open, midday, close, is most and least profitable for your style? Which instruments are you most consistently profitable on, and which ones are you trading out of boredom or FOMO? Do you perform better in trending markets or ranging markets? The answers to these questions will reshape your entire approach if you are honest enough to follow the data wherever it leads. Behavioral change in trading does not happen from motivation. It does not happen from watching highlight reels of successful traders. It does not happen from reading books, including this one you might be listening to right now. It happens from seeing your own patterns reflected back at you in clean, undeniable data, and then building a structure that makes the right behavior easier than the wrong behavior. Automate what you can. If you know you overtrade on Fridays, block Fridays until your data proves you have fixed the pattern. If you know you size up too large after a big winning day, build a rule that prevents you from trading above your standard size for 24 hours after a major win. If you know you hold losers too long when you trade from your phone, delete the app. Make the wrong behavior inconvenient and the right behavior frictionless. Putting it all together, these 5 principles are not independent ideas. They are a single interconnected system. Trading the setup, not the outcome, only works if your pre-trade ritual has made the criteria for a valid setup crystal clear. Your pre-trade ritual only works if you have genuinely processed that losses are a cost, not a catastrophe. So you are not starting each session trying to avoid the inevitable. Accepting losses as a cost only works if your position sizing means that each individual loss is financially small enough that your nervous system does not treat it as an emergency. And none of the first 4 principles compound into lasting results unless your feedback loop is honest enough, rigorous enough, and consistent enough to show you what is actually working and what is not. The traders who last in this business are not the ones with the best entries. They are not the ones with the highest IQ. They are not the ones who found some secret indicator on a forum. They are the ones who built a system around their own psychology, who understand their personal weaknesses well enough to architect around them, and who show up with the same process on the 100th trading day as they did on the first. The paradox of trading is that the more you chase profits, the further away they move. The moment you stop chasing profits and start executing process, the profits become a natural consequence of doing the work correctly. You cannot force the market to give you money, but you can build a version of yourself that is consistently in the right position, at the right time, with the right risk, day after day, month after month. That version of yourself is built through principle, not through passion, not through luck, not through finding the perfect strategy. Through principle, applied consistently across thousands of small decisions that nobody else sees and that you will never see applauded. The market does not care about your effort. It does not care about your intentions. It does not care about how hard you studied this week or how much you want the trade to work. It only reflects back the quality of your decisions across time. And across time, the quality of your decisions is determined entirely by the quality of your system. Build the system. Trust the system. Improve the system. That is the whole job.